Welcome to Money Matters, the weekly currency roundup podcast brought to you by IsraTransfer. Whether you're a seasoned investor, an expat managing your finances, or just curious about the world of currency exchange, you're in the right place. Each week, IsraTransfer's co-founder and head of trading, Daniel Engelsman, will inform us of the latest trends, insights, and market movements that could impact your money. From currency fluctuations to economic news, we're here to equip you with everything you need to navigate the ever-changing landscape of foreign exchange. So let's dive into this week's roundup. Daniel, what's the latest update on the exchange rate?
Hi, my name is Daniel Engelsman and welcome back to Money Matters by IsraTransfer. If you looked at the headlines in January, you probably expected the Israeli shekel to be in freefall. We've got rising tensions, talks of a preemptive mindset insecurity, and the constant shadow of a direct conflict with Iran. But then you look at the charts. In January this year, the shekel didn't just hold its ground. It went on an absolute, very quick gain. It gained nearly 3% against the US dollar and hit multi-year highs against the euro and the pound. But why is the market ignoring the drums of war? Or is it actually pricing in something else entirely? We're going to break down the January scorecard for the shekel, why the Bank of Israel just did something they haven't done in years, and what happens to your money if that threat of war becomes a reality. So let's take a look. January was a massive month for the shekel. We started the month for dollar shekel at around 3.18, and by the end of the month, we were touching 3.09. That's a massive 2.9% gain in just 30 days. The pound started at 4.28 and cooled off to 4.24. Euro dropped from 3.74 to 3.67. And for the Canadian listeners, it went from 2.32 to 2.28. Across the board, the shekel was the aggressor. Even when the Bank of Israel cut interest rates on January the 5th, dropping them to 4%, the currency still stayed strong. Usually, when interest rates go up, the currency gets weaker. So what's really happened here? There are three big reasons why the shekel is currently what a lot of people are calling a powerhouse. First is the tech renaissance. High-tech exports are now nearly 20% of Israel's GDP. In 2025 and into this January, we saw a surge in defense tech and cybersecurity. Billions of dollars are flowing into Israel to buy these services. To pay for them, those companies have to buy shekels. That's a constant upward pressure for the shekel. Secondly, the stock market hedge. This is the technical one. Most Israeli pension funds have huge investments in the US stock market. When the S&P 500 or the NASDAQ goes up, which they did in January, these funds have to sell their excess dollars and buy shekels to keep their ratios balanced. It's like an automatic buy button for the shekel. Third, a shift in sentiment. In January, the Bank of Israel projected 5.2% GDP growth for 2026. The world is looking at Israel's economy right now and seeing a repricing of risk. They aren't seeing a war-torn economy. They're seeing a resilient, tech-driven engine that survived the worst of 2024 and 2025 and is now accelerating. Part 3, the Iran factor. We have to be honest, this strength is fragile. Right now, the market is operating on a ceasefire assumption. But the rhetoric regarding Iran is at a boiling point. Experts like those at RAND and the Jerusalem Strategic Tribune are warning that the detente won't last. If we see a direct escalation with Iran, three things happen instantly. The flight of safety. Investors will dump the shekel and buy the dollar. We could see the dollar jump from 310 back to 350 in a matter of days. The energy spike. War with Iran means oil prices go north of $100. Since Israel imports energy, this sends inflation through the roof, killing the Bank of Israel's plan to keep cutting interest rates. Fiscal overextension. A war would blow out the budget deficit, which is currently targeted at 3.9%. If that doubles, the shekel loses its stable status.
And finally, any advice for those looking to exchange funds over the coming weeks?
So what's the bottom line? January was a victory for the shekel. It showed the world that the Israeli economy is structurally stronger than people think. But, and it's a big but, the war premium hasn't disappeared. It's just been suppressed by good tech data. What should we watch out for? Keep an eye on the 3.00 level for the shekel against the dollar. That's a massive psychological flaw. If we break below that, it's a total regime change for the economy. On the flip side, any headline involving red lines in Tehran is your signal to expect a sudden shekel dip. If you're buying from abroad, enjoy the strong shekel while it lasts, but don't assume the Iran shadow has been lifted. Let me know what you think is going to happen over the course of the next month. We've got this whole of February, and we'll do another one of these at the beginning of March, around Purim time. So I'd be really interested to know your thoughts. Thank you so much and have a good day.
And that wraps up this week's Currency Weekly Roundup. We hope you found this episode informative and engaging. If you enjoyed today's discussion, be sure to subscribe and let us know if you have any questions you'd like Daniel to answer. For more information on currency exchange and to stay updated with the latest trends, visit us at IsraTransfer.com. Join us next week for more insights and analysis. Until then, stay informed and take care. Disclaimer. This podcast provides general information about currency exchange and buying or selling currency. It does not constitute legal, financial, or investment advice. Listeners should make independent decisions and seek professional guidance. The company is not liable for any actions taken based on this content.